Hello and welcome to the special show. It's a big day for markets today as the Reserve Bank of India really left interest rates unchanged. Pretty much what the street has really expected. So it's bang on to the prediction that we had given you yesterday. Now, Governor Rajan also said that the central bank will stay in an accommodative mode. However, there may be no change in the policy till the next budget, factoring inflationary risks emerging from the pay commission recommendations and the impact of government's one rank, one pension policy. Now, Governor Rajan does not fear the volatility post the impending Fed liftoff, which he believes will be temporary in nature. We'll see how that really impacts monetary policy going forward. Now, even as he puts the government's fiscal math on the watch list for now, there was a big vote of confidence from the RBI governor on the economic recovery. So the policy, a status quo going forward, accommodation or not, we will have to see. Hear out Dr. Governor Rajan.
Reserve Bank held rates today. Going forward, we will follow developments on commodity prices, especially food and oil, even while tracking inflationary expectations and external developments. Of course, the implementation of the pay commission proposals and its effects on wages and rents will also be a factor as we consider policy in the future. However, we believe its effect on aggregate demand will be offset by appropriate budgetary tightening as the government stays on its fiscal consolidation path. Now, we are focusing on transmission. Thus far, we haven't seen, we've seen barely half the interest rate cuts since January pass through. We're working with the banks on a new methodology to determine the base rate. It will be based on marginal costs, and it should be put out sometime this week. We're also, the government is considering the small savings rates and tying them more to market interest rates. And I think both these actions will help transmission. Also, banks are currently engaged in a process of cleaning up their balance sheets, and as they clean them up, they will have more room for fresh lending. We will use the space for further accommodation when available, while keeping the economy anchored to the projected disinflation path that should take inflation down to 5% by March 2017. We are still accommodative. I think that is very clear. We're always vigilant, so this is not anything new. We are vigilant. There are obviously both upside and downside risks to consumer price inflation. We've highlighted some of the sources of risks going forward. One could imagine that there could be downside risks from, say, commodity prices, especially oil. But of course, given where oil is produced, there are also potentially upside risks if there are political events that constrain the supply of oil. There are some residual uncertainties about what the Fed will do. But my sense is, as I've said before, after an initial bout of volatility, we probably should see Indian markets stabilize and come through. So it's not, as I've said before again, the central factor in our deliberations going forward. As far as the fiscal deficit goes, clearly both the quantum as well as the quality matters, and that is an issue which the government is fully seized of. I'm hopeful that while maintaining the fiscal consolidation path, the government can also maintain the quality or enhance the quality of the budget. So it is clearly an issue that they and us will both be looking at. In the broad sense, I mean, yes, there's going to be additional expenditure, but there will also it will be offset presumably by either additional revenue raising or cuts elsewhere, so that the fiscal consolidation path is maintained. So in that sense, we don't feel there will be a significant effect on aggregate demand, provided, of course, you maintain the fiscal path. Of course, investment in some ways maybe higher quality than certain kinds of spending, and therefore one would hope that you would uncover space elsewhere for the public investment which we really need. And I think the government has taken a number of these into account while anticipating the consequences of the pay commission. So let us wait and see what happens. We are in the process of a recovery. We're in the midst of a recovery. Now, there are areas of weakness. There are places, of course, where you would, agriculture, for example. Agriculture is growing relatively weakly because of the monsoons. Allied activities, dairy, etc., are growing more strongly. But as a result, rural demand is somewhat weak, and you see non-durable consumption, for example, relatively weak. Set against that, capital goods has grown fairly strongly. Public investment seems to be growing quite strongly. So I think what we have is an economy which is well and truly in recovery, but with areas of weakness. And hopefully, as we go forward, some of the areas of weakness will turn around. For example, with the kind of investment that is contemplated, construction may start picking up more strongly, and that will be very helpful. Perhaps with the kinds of measures that the government is taking, as well as, for example, on low-income housing, the capital requirement measures that the RBI has announced will have some boost to housing. Services inflation is obviously a source of concern. I think it largely reflects the supply constraints in our economy, that high quality education, high quality healthcare, or reasonable quality healthcare and reasonable quality education are relatively in short supply, which is why you see higher inflation there. And that's one reason why we keep saying this is not just about food, it's about other elements. Now, that has been coming down over the last year or so. As far as taxes go, that's not wage or price push inflation, and we'll have to figure out a way if as and when GST comes in, for example, and there's a big change, how we account for that going forward. Dollar and ECB moving in opposite directions, it does create problems for countries like ours. Because partly people are not aware of the concept of real effective or nominal effective exchange rate. The one exchange rate that always matters is the dollar rupee. So at the same time as they're saying dollar rupee weakest in the in the history of the rupee, turns out that we're pretty strong because we've appreciated versus the euro, versus the yen, versus many Asian currencies. If you look at, say, 1 to 3 year deposits, banks have already cut significantly more than has been transmitted through the base rate. So in that sense, there is room building up for the banks to transmit more. I think it's a matter of time as these costs flow through. What the marginal cost pricing does is make the costs flow through into lending rates faster. So the intent is that at least for a time, banks will have will be able to make loans, incremental loans on the marginal cost pricing, while their historical or their legacy loans will be on the base rate. That is the intent as we go forward. My hope is as the banks recognize more of what needs to be recognized and they deal with the stressed assets. Remember, stressed assets, NPAs plus restructured, is a important part of bank balance sheets. That they will be able to bring that down, and not just by provisioning, but also by putting some of these assets back on track.
All right, so that was Raghuram Rajan talking about the entire policy. We have with us our consulting editor, Maithili Bushnur joining us with an expert analysis of the 5th bi-monthly credit policy by the RBI. Maithili, good to have you on the show. What is your first take? Of course, it's an expected lines and the pause has been given, which the markets really expected. But what is your overall sense on the future trajectory as well?
Well, the RBI's monetary policy announced on Tuesday is broadly on expected lines. There are no surprises. As expected, the RBI has kept all policy rates unchanged, and this is entirely anticipated given the fact that the Federal Reserve is meeting the middle of December, 15th and 16th, and depending on whatever rate action the Fed decides, India's policy stance will have to take that into consideration. So quite understandably, the RBI has taken a wait-and-watch stance, and that is entirely in keeping with what is warranted and what market expectations really were as well. Fortunately for the market, it has not read the fine print of the policy statement, because if you look at very carefully, while the RBI has kept both the inflation rate as well as the GDP growth rate unchanged, the projection unchanged, in both cases it says it is a mild downward bias. That is, it is admitting that inflation could be marginally higher and growth could be marginally lower. So in both cases, that was not a very good indication, but markets have chosen to ignore that. They've gone by the fact that the RBI has kept policy rates unchanged and is fairly confident that it is on the right policy trajectory.
So Maithili, what do you think? Is there a likely rate cut that we are expecting on 2nd February when the RBI meets again for its policy, or will RBI really wait until the budget, which is a popular perception now?
Well, it's not a question of the budget really. I think everything really hinges on the Fed action, because like it or not, the US Federal Reserve has de facto become the central bank for the entire global economy. So almost every central bank in the world will have to take its cues from what the Fed decides. So the RBI also will be guided not so much by the budget as really by the US Fed action. If, of course, the US Fed action is on expected lines, then maybe the budget will come into play, especially since we really don't have any certainty on the fiscal deficit numbers, especially because our nominal GDP numbers are likely to be lower, in which case the government will have a very tough time sticking to that fiscal deficit target of 3.9%.
Maithili, the policy statement did say that CPI inflation and uptick on the non-food inflation will be something that the RBI will be vigilant about. So is there any concern that the RBI has from the inflationary trend, given that food inflation and also the 7th pay panel recommendations that have been really cited in the policy statement as well?
Well, as far as the pay panel recommendations are concerned, they are not likely to be affecting this year's fiscal deficit, unlikely to affect inflation this year as well. But as we move into the next financial year, it will have a huge impact, because if you look at both the 5th and the 6th Pay Commission reports, they really impacted the government's finances very adversely. And at a time when the entire recovery process is being driven by public investment, because private corporate sector is not stepping up, then in that case, if government does not have enough money to invest, it could have pretty adverse consequences for the economy. So I do hope that the government will take courage in its hand and at least keep the policy, the Pay Commission recommendations on hold and say, look, let's wait until the economy recovers and then we will accept those recommendations, implement those recommendations in whichever form, because as we've seen today, at the lower and middle levels, government servants get much better paid than the private sector. So there really is it's a very difficult choice for the government, given that this is a populist stance that all governments have taken in the past, but it needs to be done.
All right, Maithili, of course, some of the big macroeconomic data coming in from the West is also something that Governor will be watching out for. But thank you so much for giving your expert take and the full analysis on the RBI's policy. But don't go anywhere. It's time for a short breather on this special edition. But we'll come back with many more voices and the analysis of RBI's credit policy. Stay tuned to ET Now. All right, it's the day of the big credit policy announcement where a pause has been really pressed by the RBI governor, as had been anticipated by the entire market. Now, the government says that the central bank's policy stance will really help contain inflation at this point, and the Economic Affairs Secretary Shakti Kanta Das tells ET Now that from here on, much will really depend on how prices behave.
I think the RBI's announcement is on expected lines. And RBI has maintained a balance between its monetary policy objective of dealing with inflation and also looking at growth. I think it's a balanced policy call between inflation and growth. The RBI has also mentioned that they want to be watchful, they want to be vigilant, at the same time they want to be accommodative. So I think on the whole it's a very balanced approach they have taken, especially with the US Fed rate announcement to be done by the US Fed towards the end of this month. That is somewhere in the corner. So keeping all things together, I think it's a balanced and considered policy call which the RBI has taken.
Do you think, sir, that there is room for more easing of rates if retail inflation is kept below the targets and the government sticks to its roadmap of fiscal consolidation?
See, I would not like to talk about whether there is more room for rates or there is none. Our target is to contain inflation. WPI continues to be in the negative territory. Consumer price index around 5%, so that is something which the government is dealing with, and especially on the back of a very poor monsoon again in the second or third consecutive year. And with pulses prices, the price of pulses, government measures now beginning to show results, and the crops also will come into the market maybe in a month or month and a half. We have to see and we have to be very watchful about the overall inflation situation, and we have to see also what decision the US Fed takes. And I'm quite sure that as the monetary policy authority, the RBI will take into consideration the growth requirements of the country and its monetary policy objective of maintaining inflation.
In fact, talking about growth, Mr. Das, the RBI has kept its growth forecast at 7.4% with a mild downward bias. What do you make of this commentary given the fact that the GDP has also grown by 7.4% in the September quarter?
See, first quarter, as you know, was below expectations. It was around 7%. Second quarter at 7.4% is a very positive trend, very satisfying trend, especially the major driver, one of the major drivers of the growth in the Q2 in second quarter has been the growth in the manufacturing sector at 9.3%. Now that somewhere it demonstrates that the whole policy of Make in India is playing out and it is bearing result. And then yesterday also two big investments have been announced by the Indian Railways, the GE and the Alstom. And with so many investments coming in and so many policy measures which have been taken, I would expect our outlook is a little more optimistic, and we are looking at about 7.5% or so. I'll tell you, I'll supplement, I'll tell you why. If you see over the last few months, the government has undertaken a series of reform measures. I don't want to narrate them for the sake of brevity. But look at November. I think November has been a month of strong economic reforms. On 5th of November, the Honorable Prime Minister launched the gold schemes, the gold monetization scheme, the gold bond scheme, and the gold coin schemes. Now, the gold bond and the gold monetization scheme, basically their objective is to convert investment into gold and idle gold into financial savings, into instruments of financial savings which can turn into investment. Then on 10th November, the government announced a huge dose of liberalization in FDI policy. I think after 1991, this was perhaps the largest liberalization of FDI policy that has been done by the government. And then again yesterday, the Reserve Bank of India has announced liberalization of the external commercial borrowing, ECB norms. The revised framework is far more liberal, and it is the outcome of several weeks of discussion, very positive and proactive discussion between the Finance Ministry and the Reserve Bank of India. The banks have their own autonomy to decide their interest rates. The transmission has been in the region of about 50-60 basis points by some of the banks. Banks also have their own problems. And so far as government is concerned, with regard to small savings, it is work in progress. And one would expect the announcement to come quite shortly with regard to small savings. Already, this is not something new I am telling you. This was already stated by the government during the earlier policy announcement, the rate announcement by the RBI when there was a reduction of 50 basis points. So it's work in progress. We have to also keep in mind the interest of the small savers and the senior citizens and the saving scheme relating to the girl child. Their interests will have to be taken into consideration, will have to be duly protected. So, I think rate transmission is taking place. May not be to the satisfaction of some, but I think one would expect things to improve in the coming weeks.
Rising NPS, that's another spot of bother in the banking sector, and that's cast a shadow over corporate earnings. What steps does the government intend to take to curb the NPA menace?
See, the Department of Financial Services, which is a part of the Finance Ministry, they are working on this particular challenge. various options are under consideration. Within Finance Ministry, this is being very actively discussed. So we have to wait. As and when any decision is taken, you will come to know about it.
All right, so that's the view coming in from the government on the credit policy. Let's also hear out some of the important reactions from economists, marketmen and corporates on the RBI's decision today.
It's not that the pay commission is going to increase aggregate demand. Aggregate demand will be determined by how the overall fiscal deficit evolves, and the point I think that the governor was trying to make is that is not changing. We know that the fiscal is going to consolidate, or we hope it will, by 0.4% of GDP. The worry is more about the composition of that consolidation. Is that to accommodate higher wages, will we have to crowd out public investment? Let's not underestimate the role of the government in the latest GDP number. Government spending went from 1% to 5%, and almost all of the fixed capital formation that we are celebrating today is on the back of higher public investment. Capital goods spending by the government rose 40% year on year in the third quarter. So that's the real concern, that will that be crowded out in the next fiscal year and therefore affect both inflation but also potential growth.
We're going to have a very different kind of a recovery this time. It'll be more muted, but I think a recovery is underway, and but we will operate at sub optimal or sub potential levels for a while to come, and I don't see us climbing substantially over 8% in by before say 2017 end or maybe 2018 middle.
If you really look at our export contraction headlines, yes, definitely has come down, but yes, we do import major oil, but we do export the finished product, and I think that's the reflection. So when you see the overall exports come down, the dramatic number, the last number which I showed was something 24% lower or something, that's because a major component of that is also oil.
Clearly, this policy does suggest that we are on a pause mode for some time, and the next action, if at all, will happen post-budget after analyzing the data. There is a reasonably good chance this time that inflation may not go up as much as expected or priced in by the market due to pay commission revision. I think that from here till FOMC, rate sensitives will probably remain range bound with little bit of downward bias. And post FOMC, they probably will start moving up as Fed says that, look, we are going to be gradual and calibrated rather than Wild West into rate hiking.
Transmission, like everybody knows, about 75 basis points of transmission has happened out of the 125. So still maybe 50 to go. But as bankers have been constantly pointing out that as the year matures and the fixed deposits mature, they will pass it on. But the bond markets have definitely passed on all of that, and that's the best proxy. But of late, we are watching for the last maybe 15 days to 1 month that the bond markets themselves are tightening, which means I don't mean the GSEC market, I mean the corporate debt market. That has tightened by about maybe 30 basis points. Even the short-term CP rates have actually tightened from about 7.2, maybe 7.5 to 7.8, 7.9. So clearly some tightening is happening, and I think that's to be accepted as part of par for the course.
All right, so those were the important views coming in on the RBI's policy announcement today, and some of the points to ponder going forward. Well, status quo this time, but will there be enough jitters coming in from global events like ECB meet or US Fed liftoff to define the monetary policy for the RBI going forward, or will it wait and watch till the budget next year? Thanks so much for tuning in.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.